you can kind of slice the pie any way that makes sense for you. That's one of the benefits of tax insurance. It's extremely bespoke. It's probably more popular to have a tax credit insurance policy that covers both the buyer and the seller. And I say popular in the sense of buyers want to know that they can walk away and not worry about what they just bought. Sellers want to know that they can walk away and know that there's a pocket to go into if the IRS hails it away. And the insurers want to know that both parties have skin in the game so that they're both being serious about this insurance that they're getting. But that doesn't mean that that's the only way that it's done.
Hello, and welcome to the Future of CRE Sustainability. I'm your host, Sean Swentek. Today, I'm joined by Marc Nickel, Senior Vice President of M&A and Transaction Solutions at Aon. Marc, thanks for joining me today.
Thanks, Sean. Happy to be here.
So you and I were both in San Diego last week at Solar Plaza's event, Asset Management in North America. Some say AMNA. Really great event. A lot of movers and shakers in the industry were there. I know you spoke on a panel. What was the most exciting thing for you at the event? What did you take away? What were some of the top themes for you?
Honestly, I think that it's how vibrant the space is. I've been working in renewable energy projects for better part of a decade in one form or another. And there are so many new market participants and so much technology being brought to bear to simplify the process, to streamline projects and get them off the ground faster, cleaner. There are people walking around with drones. Everybody was talking about AI. It honestly feels like it's always been bleeding edge technology, but it's these days it feels like I'm living in the future when it comes to this industry that I feel like I've been part of for a long time.
It's getting to the point it shows on our industry that I think we have to wear like a button that says like safe to talk about AI, yes or no. Like it's like the number one thing everyone wants to talk about. It's crazy. We're seeing AI everywhere and automation and all these things that are coming in the industry, and it's revolutionizing a lot of industries right now. How do you see technologies like that transforming energy management, risk management, all that as it comes to like sustainability in commercial properties?
Yeah, it's a great question. So I come at this from the tax professional perspective, right? And so the basis of so many of these transactions is on the quality of being able to support the tax answer, the tax credit that you're bringing to bear. That's driving your margin on your project. So the primary way that has really been commercialized that I've seen is using software-based solutions, deeper dives into data in order to have a much, much cleaner record so you can feel a lot more secure that you've gotten the right answer for your tax credit claim. That's the number one thing that technology is doing. It's making it safer to feel comfortable to transact on these credits.
It's what we're hearing in the market as well. Like one of the biggest feedback pieces we get all the time is trust. Like this is somewhat of a nascent industry to a lot of these folks who've been dealing in commercial real estate forever. It's like, even though sustainability has been built up over the last 20 plus years, there's this concern around trust and being able to trust the data and the information that comes out of it, and that these assets will return what they expect. So I think that's a great call out by you.
And I'll layer onto that too, that, when you're talking about the commercial real estate industry, there's been a lot of interest in creating government incentives to combine that industry with renewable distributed energy generation. And the key factor is, how do you combine those two things and get a bunch of people who haven't done them before to have that trust that you were just talking about? And I'm seeing it a lot in these tech solutions, so that people don't have to rely on some sort of learned advisor. They can actually do the deep dive into the data and literally have something concrete to put their fingers on.
100%. What do you think is the biggest opportunity for sustainability in the built world today?
Challenging question to answer because there are so many of them. What I think is the biggest opportunity is, frankly, monetizing space that beforehand was just the roof of your building, right?
Yep.
So you now can both cover off your particular energy needs for your whatever facility you have going on there, but then you're probably generating more than you need. And so you can get cost savings in the form of credits back from your local utility. And it's a massive savings. That's a direct decrease in overhead costs.
Hard to say no with that argument.
But even more than that too is, say I have a commercial real estate portfolio and I've on top of just the actual function of the distributed generation, in the wake of the Inflation Reduction Act, you can actually go out and directly sell your ITCs that you're going to generate from building solar on top of your warehouse. And now, not only do you have the benefit of operating this project that is saving you on your power, you are getting cash from a third party for some tax credits that you may not want to use yourself. And nobody doesn't like getting cash that they weren't expecting.
Yeah, it's really because, I mean, as long as the ITCs are sticking around, it's become kind of a no-brainer. If you have the right property, you have the rooftop space, you're paying almost half of what you would pay thanks to the tax credit return, the cash you can sell. You're getting the tax credits back from the investment, and yeah, to your point, when you're overproducing, you're selling it back to your utility. It's like it's just such a win-win-win.
Agreed.
How are your clients approaching investment tax credits? You mentioned them earlier. And what advice would you give to others looking to maximize those benefits?
So, great question. I would say if you had asked me about the clients for tax insurance 2 years ago, they would have been different than the clients that exist today. The clients that existed several years ago were large scale developers only doing deals with large banks in traditional tax equity partnership scenarios because that was the only way to monetize tax credits. These days there are far more participants at all different scales who are able to directly transact in their tax credits. So that's the type of and I have been in this industry of tax insurance for a little over a year after having been a practitioner for 17 years. And I I have seen a people who just did not make sense from a dollars and cents standpoint to participate in tax equity who are now out there having a massive appetite for building solar, building battery projects, and getting those all together to serve their needs, but also to transact on those credits that they have, like I just mentioned, because nobody doesn't like unexpected cash.
You kind of hinted at it, but how has the Inflation Reduction Act changed the landscape for tax credit and tax credit transferability, especially as it
Yeah.
relates to commercial solar?
Sea change, right? So it's a like I just mentioned, monetization strategy used to be very complex tax structures involving partnerships and partnership law, and lots of lawyer fees. And as one of those lawyers who participated in earning those fees, that was a great way to make a living. But these days, it can be quite a bit more simplified, where you can literally just have a transfer agreement where I am small scale commercial real estate owner who teams up with small scale developer, and we both walk away having sold credits to a completely strategic third party who has no business in the energy industry, but they're just looking to get tax credits to offset their income tax. And it's sort of a no brainer solution. But even broader than that particular monetization strategy, the Inflation Reduction Act it literally put a kickstart into the American economy that didn't exist in the previous years. I believe the most recent statistics that I saw was that in the 2 years from the summer of 2022, when the law passed, to the summer of 2024, there was something like $800 billion of private investment in the sector. And that's just, and there are 300,000 new jobs in the sector. And that's just a wild number to have, fly over the transom in a 2 year period of time. And it makes me bullish on the prospects for that industry going forward.
100%. And it spawned like this whole new business model of these sort of tech-enabled platform, these tax credit marketplaces that you're seeing pop up all over. There's, Evergrow and Basis and Crux and all these businesses that are like growing gangbusters because they're servicing this tax credit transferability at scale and using automation and technology. So really interesting to see all that pop up.
And sort of that's the role that I, as a tax insurance broker, play. I have contacted all of those companies that you just named and several others, because everyone is, it sort of goes back to that thing you were talking about with trust, right? When you're transacting in those credits, you need to make sure that you're comfortable that if the IRS comes in, you've actually got both the audit trail to support the credits that you've claimed, to support the credits that you've transacted on. But then also you want to make sure that there's a pocket to go into if the IRS trims the value. And that's sort of where tax insurance works, right? We are able to be a credit backstop for a very reasonable cost that allows companies to know that they don't have to support the value of these credits just with their balance sheet alone, or more expensive options like setting up an escrow or getting a letter of credit.
Some listeners might just be wondering, what is tax insurance? Can you explain tax insurance related to solar projects specifically in real simple terms for those that might be unfamiliar?
Yeah, I'm prepared for this question because I've explained what I do for a living to my mother before. And basically, think about it this way. Anytime you have a tax provision, right? Something you're going to put on your tax return where you have asserted to the government, I did a certain act that has a certain tax consequence. If you can get a piece of advice from a tax lawyer or a accounting firm, primarily at more likely than not or better levels of confidence, you can probably get a tax insurance policy to say, yes, you've calculated your taxes the correct way. And then if the IRS disagrees with you on a good faith, that you did it on a good faith basis, but the IRS just says you were wrong, then the tax insurance can stand in and pay the IRS on your behalf. So in the solar project space, what that often looks like is insuring sort of three buckets of risk. One is the structural risk of the actual tax strategy you use to monetize your tax credits. The next bucket of risk is qualification risk. That those tax credits are they are at the value that you've represented them at. And those are things like, did I build it with the right technology? Did I build it and place it into service on the right dates? Have I used the correct labor and apprenticeship in order to, meet the prevailing wage and apprenticeship rules? So qualification is a very big bucket. And then the third and final bucket for solar projects in particular, ITC projects, is recapture risk. So if that project is destroyed or taken out of service for some reason before day one of year 6, and the IRS comes to hail back some of those credits, insurance can make you whole or your investor whole.
You talked about a couple of the risks there. Obviously, this costs money and it's an investment and it's against these risk factors. Do you want to go deeper on any of those common tax risks that folks might not be thinking about as they're implementing these solar projects?
I mean, the number one tax risk that folks probably aren't thinking about is literally, have you gotten the right information in order to support the credit at the value that it is, right? So these are things like appraisals and cost segregations. These are very important documents that come together from valuation firms. And those are really sort of the backstop of the math that says, so you might spend, $50 million building a solar installation, but you need to make sure that every one of those $50 million is creditable in order to claim your 30% ITC against it, 30% or better ITC against it. Otherwise, the IRS is going to come in and said that you were too greedy. And so that's sort of like the value of what tax insurance does for you as well, right? Because there is an underwriting process where someone who is a third party from you is looking at what you did in order to claim that credit amount and signing off on it and agreeing with you. And so you've already had that sort of set of eyes on it that is in many ways equivalent or even superior to the review that the IRS.
Smart. Tax credit transfers obviously have a seller and a buyer of those credits. Is tax insurance play a part in protecting both those parties?
Indeed, it does. You can kind of slice the pie any way that makes sense for you. That's one of the benefits of tax insurance. It's extremely bespoke. It's probably more popular to have a tax credit insurance policy that covers both the buyer and the seller. And I say popular in the sense of buyers want to know that they can walk away and not worry about what they just bought. Sellers want to know that they can walk away and know that there's a pocket to go into if the IRS hails it away. And the insurers want to know that both parties have skin in the game so that they're both being serious about this insurance that they're getting. But that doesn't mean that that's the only way that it's done. There are seller-only policies, there are buyer-only policies, and the individual nuances of those are probably a little more dry than you want to get into in this conversation, but obviously happy to have that conversation at any time.
Now, there are a lot of different types of commercial real estate properties, and our listeners, span the gamut from multifamily to industrial to hospitality and whatever it might be. Are there key differences in tax insurance approaches for one versus the other?
There can be, right? One of the natural things that happens with tax insurance, because an insurer is taking on risk and they have minimum premium amounts and they have underwriting fees, you don't want to. So, like the sort of cardinal rule on tax insurance is that your all in cost it could be between about 2 to 5% of your limit of liability that you're looking to cover.
Got it.
And facts and what you're putting on the table and your particular transaction obviously helps you move within that relatively big range. But when you're below, say, like $5 million is when you really start seeing that cost in terms of per dollar insured go up above that 5% all-in number, right? So the reason why I brought that up is that if you are a smaller scale developer, right, and you're putting a bunch of, say, 2 megawatt projects together, you're probably going to want to find an insurance solution that allows you to get a portfolio insurance, right? Wrap a bunch of those projects together under one policy so you get the economies of scale instead of trying to insure each individual 2 megawatt project. Now if you're a commercial developer and you're developing on a gigawatt scale, that's less of an important dynamic. But there's any number of different ways that it can be done. And Aon has done this, for residential solar companies for many, many years in terms of, figuring out the creative solutions to have a policy period that stays open. You can contribute the individual very small, 6 to 10 kilowatt projects into a insurance program over time, paying on a pay-go basis, but you're eventually getting, the benefit of having these, $100 million, $200 million insurance policies, but you're paying for them all along as opposed to having to pay for that upfront. It's very, like I said before, and I'll say this probably 10 more times before we're done talking. It's very bespoke. It's customizable to what you need it to be.
Very cool. At what point in the solar project development life cycle should property owners start considering tax insurance?
I think when your monetization strategy is becoming clear to you, that is when it's probably the best time. And I say that for a couple of reasons. Number one, it's kind of hard to know what you're trying to get insured, what particular covered tax positions are going to be important before you know what sort of tax structure you're going to be using to try to make money off of your credits. But the other side too is that there is a counterparty in your monetization strategy, and they are going to want to know what the insurance is going to cover. They're going to have opinions about what that coverage needs to look like. And that doesn't mean there's no wrong time really to call me up and say that you're looking into tax insurance, but the time that's going to be most productive for you is when your transaction is coming into focus and the parties to that transaction are coming into focus, because that's when you're going to be able to get the most return on your efforts. That's going to look like your finished project more at the beginning.
You alluded earlier to like documentation risks as a big factor. What are those most common mistakes that can lead to like an IRS dispute over solar tax credits?
Like I said before, and the cost segregation is a big one. The appraisal risk is a big one, right? So depending on what strategy you're using to monetize your tax credits, you might have taken a project all the way up to the last stage before you turn it on, selling it into a partnership structure and get a developer step up on that project. That developer step up is an important sticking point between developers and the IRS.
Yeah.
And it's also an important point for insurance to get comfortable with it. So there's the documentation about supporting those step-ups is really important. The documentation about your prevailing wage and apprenticeship compliance is extremely important. I think so there was a period of time, if you had started the construction of your project before the end of January 2023, you could be comfortable knowing that you didn't have to comply with those rules. I think the days of seeing the projects that are grandfathered into the old rules is kind of over now. We're pretty deep into 2025 now, and I haven't seen too many projects come across my desk recently. They're relying on the old rules or able to rely on the old rules. So figuring out how to document that you've paid people the right wages, that you've used enough apprenticeship labor to actually qualify. The good news about that one, though, is that there are a lot of secure payment off ramps that the IRS offers, the Treasury offers, in order to allow you to not lose the full value of your credit. You can just sort of pay your toll and get your 30% ITC restored. Those are probably the two biggest documentation focused areas, which makes sense. They both sort of rely on the math. Things that are a little less, that is also very document important, is the tax advice itself,
Mhm.
right? The qualification risk that I mentioned earlier, right? Are you able to get a more likely than not or should level confidence from a tax advisor that you've built this project in the appropriate way to qualify
Mhm.
for the ITC? That's an important document to have, that piece of tax advice. Well, in order to get tax insurance, it is basically a rock solid necessity that you have that advice. And that applies doubly to if you are layering on a complicated tax structure on top of it. A lot of people are monetizing their tax credits both by using a traditional tax equity structure and then selling the tax credits after you put that structure together. Getting tax advice on top of it that blesses those structures, blesses that qualification, extremely important document to get.
So you mentioned earlier a 30% baseline investment tax credit that makes great financial sense for many projects today. And there are other bonus adders like energy communities and LMI designations. How are these changing the economics even greater for these commercial solar projects?
Yeah, and I'll add on the domestic content adder,
Yeah.
which is kind of a challenging one to get for solar, although it's easier and easier every day. How are they changing the economics? What they've done is they've made the margins of solar actually make sense in states where it never made sense before. Places, in the deep Midwest that had very inexpensive natural gas or even coal fired, it didn't make sense to deploy solar because that was still very cheap energy. Now you can go out and you can get, maybe a 40, maybe a 50, maybe even a 70% ITC on your project. And that has bent your cost curve dramatically lower. And so it makes sense to deploy solar in Oklahoma, where it never did make sense before.
One of the naughty words in this space is recapture, and there's so much like worry around that sometimes, and sometimes valid, and sometimes not. What are those misconceptions that commercial real estate developers typically have about IRS recapture risks?
Yeah, it's a great question. It's a question that gets asked all the time because recapture is one of the most important things that folks come wanting to get covered. And paradoxically, and it's great. It should be something that should get covered. It is a massive amount of risk if the IRS comes in and says you transacted in the wrong way and you have a footfall and now your credits don't exist anymore. That's a massive failure, which is why, a big chunk of this tax insurance industry. The thing that I think folks get wrong about it is how risky it actually is. So I don't have the numbers in front of me, but I've looked at these numbers multiple times over the course of my career. And let's just put it this way. The amount of solar that has been deployed over the last 10 years is many gigawatt scale. The amount of recapture that happened is very low megawatt scale. So we're talking orders of magnitude of lower amounts of recapture. And actually, personally, as a former practitioner, I have only ever encountered recapture in situations when it was done voluntarily by a project owner because they realized that, so like a hailstorm had come through
Yep.
and damaged their project, and they realized that they could scrap part of the project, repower it, put new panels up, and get a better tax credit than they were waiting to run out for the last
Yep.
couple of years of their recapture period. So you're 100% right. Recapture is a scary word. And it is an important thing to make sure you don't foot fault your way out of. And the way you don't foot fault your way into it is have sufficient property and casualty insurance to make sure that you can actually get your project rebuilt and it doesn't just sit there broken. And also, if you are funding this thing with project level debt, make sure that you are lining up that project level debt so that you can't get foreclosed on and someone can't take your project away from you. And the reason why I bring those two things up is that those are key mitigants to show the tax insurance markets if you want to get your recapture risk covered as well. Fairly formulaic to get recapture covered if you can provide that particular level of support.
How should property owners approach the underwriting process around a portfolio of solar projects across multiple properties?
Great question. We like to call it as designing the box, right? So if you have projects that look similar, right, you're going to have a simpler underwriting process if they look the same, if they are between a certain level of generation capacity, if they are in similar geographies, if they have similar use cases, similar off takers for the energy, all of that stuff makes the box simpler. And so that will save you a lot of money in underwriting and future underwriting costs in order to drop projects in. And some folks don't have that latitude to have very similar looking projects, and that's okay. Like I promised I would do. Tax insurance is very bespoke. It's very flexible. You can always make it work. You just need to manage your expectations about what your bring down reports and your future underwriting will look like if each project looks different. That doesn't mean you won't get the economies of scale from getting the larger size, upsizable policy that you can drop future projects into. It does mean that the individual process of dropping a different project in, might be a little more complicated than if you've designed a box where things look very, very similar.
That's smart. What are the trends you're seeing in tax equity investors as they evaluate commercial real estate solar opportunities?
That developer step up that I mentioned earlier, tax equity investors are not interested in taking big swings anymore. There are a number of them that have sort of just capped their appetite at 20% or below, which the IRS has signaled is, sort of a safe harbor, not a formal one, but just like a litigation position that they won't be too bothered by step-ups at 20% or below. And also, most of the tax equity investors these days, so if you'd come to me, even like a year and a half ago, tax equity investors were coming in and they were wanting to insure step-ups and recapture risk and a handful of other, some of the riskier parts of the ITC. They'd, if you had $100 million of ITC, they might want to cover, $40 million of it that was allocable to those riskiest parts. These days, they're all using hybrid structures to both use tax equity and then sell the credit. So, folks call them T flips or hybrid structures. When you're doing those T flips, folks want full wrap tax insurance now. They're not just looking to insure step ups and recapture. They're looking to insure an entire basket of risk from the structural to the qualification to the recapture. And they're looking for more than 100% of the value of the ITC because they want a gross up that would cover penalties and interest and contest costs for fighting the IRS and any potential income tax implication on getting that recovery, because typically those recoveries are viewed as taxable events. So whereas the same $100 million ITC project that you could have brought me 2 years ago would probably want $40 million in insurance, these days it probably wants $125 million worth of insurance.
Kind of speaks to the sophistication that our industry is moving towards and just the risk-off environment I think that we're in today. How can commercial property owners best prepare for potential IRS scrutiny of their solar tax credits?
Make sure that you have good audit records. Make sure you know where they are, can put your fingers on them. And that's all the way up and down from the things that you use to file your tax return, but even down to your EPC that you use to build out your project. Make sure you have very clean lines of sight into when you can compel them to give you their records. Maybe you can get them to compel them to give you their records for your audit files, on day one, on a rolling basis. Documentation is the key, right? The IRS can take a look at all of your tax advisor and all of your briefs that you put in front of them, and they will still come back to you and say, great, where are the records? I want to see the DNA of this thing. So just don't lose line of sight. A lot of folks get very, very excited, and they should be very excited about building these projects because these projects are extremely valuable, both in a financial sense and sort of societally, right? But they do not lose sight that at the end of the day, there's a very sort of mechanical records-based process in order to support that you've done the right thing.
What role does tax insurance play in solar project bankability for commercial developers?
It is the backstop for the credit support. I sort of alluded to this earlier, but there's historically, before tax insurance was really something that was on the market, and tax insurance has been around in a very serious way for about 15 years, but it existed before that in other limited capacities. It used to be that if you had an indemnity that you were offering as a developer for a tax credit scenario, you had to have the balance sheet to support that with a parent guarantee, or you had to get a letter of credit that would, offer you the ability to pay out if something got trimmed. And those are fairly expensive solutions, or at least at a minimum, they're drags on your credit worthiness.
Mm-hmm.
Tax insurance, like I said earlier, is between 2 and 5% of that limit of liability, quite a bit cheaper. So tax insurance is making projects more bankable by making people not have to rely on their own creditworthiness or balance sheet in order to put this project together. Whereas in the past, someone would say, I don't know, it's going to cost me X amount of hundreds of thousands of dollars to build this commercial scale thing on top of my warehouse, but nobody's going to want to buy these credits. I don't really have the appetite for these credits. It's not worth my time. Now, but because tax insurance exists as a credit backstop, and the IRA exists in a way that you can sell those tax credits, a lot of those barriers to entry are completely down.
So, as we talk about the future of our industry, what do you predict? What's your big prediction for 5 to 10 years from now as we look at sustainability in the built world? Where do you think we're going? What might excite people about what might be coming around the corner, in your opinion?
Yeah, I mean, I think that politically, folks have been talking about what's the risk. Are all of these credits that have been, very valuable for the last couple of years? What's the appetite under the Trump administration for keeping them going? And so, whenever anybody asks me that prediction question, my assumption is they're asking that question, right? So, what I think is that and maybe I'm using rose-colored glasses here, but that number that I said beforehand about $800 billion in private investment in the United States that's been backstopped by these projects. Wall Street's making money off of this. Main Street's making money off of this. I do not expect these credits to go away. They certainly will not. I would be a fool to say that they will look exactly the way that they look right now at the end of this year or next year or 5 years from now. But they will exist in some fashion, just because, number one, they make sense. Folks are making money off of them. Number two, they make sense because folks are getting good jobs off of them. Number three, they make sense because they're supporting a manufacturing sector in the United States. And without having the ITC, what are you manufacturing solar panels for if you're not getting ITC credits, for your efforts? And they also just make sense because we're in this energy economy right now where we talked about AI at the beginning of this, right? There are data centers going up all over this country, and we need the electrons to fuel them. The fastest energy to deploy is renewables. Solar goes up so much faster than a natural gas plant, so much faster than a nuclear plant. And so there's just no reason why this doesn't make sense from just a economic opportunity. So my prediction for the next 5 to 10 years, full steam ahead. The rules will change a little bit. And that uncertainty in the rules is why you come to a tax insurance broker like me to help you figure out how to make sure you've got the rules actually correct.
And I love your 3 points: dollars, jobs, and essentially like national security / GDP growth. It's hard to argue against those 3 things. Mark, is there anything I didn't ask you about that you were wishing you had a moment to speak to and specific to the space?
I mean, the only thing I will leave is that I'll highlight my company a little bit, right?
Yeah.
So Aon, it's a global insurance brokerage. It has been around for a long time. We pioneered the space for tax insurance. Gary Blitz, who's our CEO of our transaction solutions team, a lot of people consider him to be the man who invented tax insurance. I know I do. And we have this bench strength globally, but especially in the United States, that can help you with any one of these transactions. So most of the people who are working on your matter are folks like me who were former tax attorneys working in the space. And we believe that that's the difference maker for us. to that we can actually speak the language, because the underwriters on the other side who are actually issuing these policies, they're also former tax attorneys. And so you want somebody who can speak that language, as geeky as it might be to them.
I love geeky and wonky, so you're speaking my language. If listeners want to learn more about Aon or more about you, where should they go?
You can literally just Google the Aon M&A and Transaction Solutions. It will pop right up. We have excellent SEO. You should find us anywhere. Feel free to look me up on LinkedIn, Marc Nickel. I post things about all the new developments on there. I am a geek's geek when it comes to this stuff. I'm very bullish. I tell the story about, I was a tax attorney for a number of years. When I got into the energy industry as an energy tax attorney, that's when I really started loving being a tax professional in this space. It's like a little boy who gets to play with the big toys.
Love that. Your enthusiasm rings true. I really appreciate you taking the time today, Marc. This was, for me, very enlightening and eye-opening. So thank you to our listeners. Thank you for listening in. I'll see you on the next episode of The Future of CRE Sustainability.